Good morning, everyone. This is Brad Matheny again. I'm creating this video because I had a question from one of my subscribers today about indicators and overbought, oversold conditions. So, this is one of my default charts. I talk about this in the mechanics of trading videos available on TradingView. The only thing that's new here is this GAN vibration system, which I'll explain a little bit in detail, in moderate detail. But let me explain to you a little bit about an indicator. Okay. So, first off, let's take a look at stochastics. Okay. So, stochastics down here, this is stochastics. And as was taught to me by George C. Lane, the creator of stochastics, that the combination of stochastics and RSI can be very powerful. But stochastics is a measurement of price within a range, kind of like a glass being full or empty. So, the way I want you to understand stochastics, and again, almost all indicators, is that they have a range. So let's say the range is 14 bars. Okay. Oscillator range equals 14 bars. Okay. So now what that means is that we are going to look back 14 bars. So hypothetically, from here all the way back to here, we're going to set a range. Okay. And that's what the stochastic oscillator would be doing. We would be establishing a range in this area, measuring the highest high and lowest low in this area, and then determining where price is in that range. In this case, you can see prices up in this upper range. So this would represent a 100% value, meaning that if this was our range from 0, meaning the bottom, and 100% equals the top, we would be looking at where is price in the range. So hypothetically, if price was here, the value of this would be about 55%, just above the midpoint. If price was here, the value would be 100%. If price was down here in this range, the value would be 10 or 15 or maybe 20%. And as the range changes, as we move forward, we come to here. Now we move up to here. Where is price as of here? Well, price is roughly in that area. So it'll be about 82%. Then we move forward a bar, highest high to lowest low. We come in here. And where is price at this area? Roughly the same area, about 80, 82%. Then we come forward, another bar, highest high to lowest low. Where is price? Price again is up near the high here, so maybe up in the 90% area. Okay, so now the way stochastics work, this is what is called fast K. Fast K is the immediate Stoch values. Okay, then slow K equals a average of the fast K values. That's where we get the first slowed value. Okay, so understand, and then we have what's called slow D equals the average of the slow K. Values. So what it's doing is it's making this measurement initially, and that's called the fast K. So this is called the fast K. Okay. Fast K is the immediate measurement. Okay. And that's what actually develops this up and down indicator in stochastics. Then we average it to get the slow K. Then we average the slow K to get the D. And that's what gives us this rotational moment here. So now if I come in here, I don't know if this will let me, visibility, style. Okay, it won't let me show the fast K, 1453. I'll try to remember that. But if I set the K length to 14, the smoothing to 1, and smoothing to 2, this is the fast K. That blue line is the fast K. That's the 14 bar range, up and down activity taking place. And then this is, again, remember what I'm doing here is I'm saying, give me a 14 bar range, measure price, smooth it by 1, which means I'm no moving average at all. Just give me the value. And then a secondary D smoothing of 2. Okay, so when I go back to 14.73, what we end up with is a bit more smooth value. And that's where we get into our smooth value. Now, what ends up happening here, let's talk about the faults. So the faults, again, when stochastics moves up into this upper fault, we get what is called flutter. Okay, this is called flutter, indicating that we have this. Let me try to show you here, indicating that we have this rolling of trend while we're still going up into overbought territory. That is called flutter. As George C. Lane, the creator of stochastics, taught me. Now, George Lane died, I think, in the late 90s. I can't recall, but I got to meet him a number of times doing the futures conferences in Chicago and Burbank and a couple in Florida. But very nice guy. And I literally sat and talked with the guy for hours. He was easy to talk to. We used to call him Colonel Sanders. He looked a little like Colonel Sanders, but a really nice guy. But anyway, long and short of it, so here's your fault. All indicators operate on the concept of sine wave activity. So you can see sine wave type of activity. When you get into extended trending, you're going to find that you're going to see fault in the system, and fault is going to then become your biggest issue. So you're going to have the same issue with RSI. So here's an RSI value down here. Okay, RSI is a measurement of upper closes, white bars versus down bars, and it measures the body range. So it's really measuring how much upward movement did we have versus downward movement over a 14 period average. And then it smooths that. So when you look here at this RSI, this is a measurement of how much upward movement we had versus downward movement. And what we're getting in this case is, over a 14 period bar here. So try to do the math from here to here. Remember, it's not a measurement of where is price. It's a measurement of relative strength. How much white body did we have in totality? Divide by how much down body did we have in totality. And then we create a moving average of this. So understand that in big trends, for example, let's find a nice solid trend here. I know the IWM was moving quite a bit higher. So this is an IWM. Well, we don't get much, but we can use this downtrend, I guess, as an example. So here in this downtrend, you can see that RSI moves down the blue or the purple line into oversold territory. Now, is this really trending upward here? Well, yeah, it's a pullback, but you can see that RSI and stochastics pull back fairly extensively, right? Because they're both set to 14. Remember, these values are both set to a 14 bar look back. So they're going to be essentially primed for 14 bar values. So, I mean, here's an example of a 14 bar range, okay, from here to about here. That's about 14 bars, maybe a little less, so I'll make it a little bigger. So understand that that's the only scope of what you're seeing in the market using these indicators, because you've set them, or we've set them, to 14 bars. If something were to trend like this in an upward trend consistently, this indicator would begin to fail. So you see here in this downtrend, oh, look, this is a good possible buy. Oh, look, this is a good possible buy. Oh, look, this is a good possible buy. And this does create divergence, okay? So you can see here, we get divergence in the RSI, we get divergence in price. Okay. We get a little bit of divergence over here in stochastics. So we're getting some kind of a technical indicator here, but understand that we could continue to get this in an extended trend. Price could continue to move down, and we could continue to get divergent, 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 divergent over and over and over again, indicating a warning that we are essentially outside of the range. This is what happens when you go outside of the range, which is again why sometimes I will use a longer term, like I have here, stochastics, 15, 85, and 20. And what I'm looking for here is, some confirmation. So am I getting an upward movement in RSI? Am I getting an upward movement in stochastics? And am I getting an upward movement in the long-term stochastics while my GAN vibration is up here near a 1? Indicating upward trending. So you can see when we get into this movement down, we've clearly broken below these bands. We're into downward trending RSI, into downward trending stochastics, and into downward trending GAN vibrations. So at this point, I am sticking with this trend through this longer term downward trend and not necessarily trying to pick bottoms or pick these little rotations to the upside. These are just minor little pullbacks. What I'm looking for is a broader rotation in trend to be able to determine that, okay, now I want to start buying into, deeper rotation here when we have these upward trending. So see, RSI's just moved a little bit positive, really rolled out here. So again, here's a big, beautiful example of divergence in RSI. Oops, look, divergence. Look, divergence all the way across. And you can see we've moved up to higher highs. And this is telling you we are diverging to the downside. Okay, we should be getting a very good short trigger here. Yeah, we got a nice little pullback right here. And then we moved into this rally phase and flagged. And like I said, you're going to continue to likely see divergence. You're going to see it roll here as well. And this is going to give you multiple potential setups of incorrect. And we go from there. So where we're at with this, folks, is you need to understand that indicators are they're almost like, think of them like a speedometer, or think of them like your fuel gauge. You have zero, empty, and full. What happens if you go to 150% full? Well, you just did full. That's all you get. You don't get 150%. And that's what indicators do. They measure trend strength or direction or range or differences between two indicators over a look back period. And that look back period is determinant, is kind of like the maximum and minimum of your fuel tank. So if you have a 12-gallon fuel tank, it doesn't matter if you can hold 22 gallons in extra tank somewhere. You're going to be full and you're not going to know that you have extra because your gauge doesn't go to 22. It only goes to 12. And that's again what you have here. These gauges don't measure beyond 14 bars. They don't. They measure only what's taken place within the 14 bars, in this case, too. In this case, it measures 15 bars, but it smooths it out by 85 and 20. So this is a more longer term kind of a swing mode in this trending system. So you need to understand that all indicators have primarily this fault, especially if they're set to a specific range, MACD, CCI, Williams percent R, stochastics, even, moving averages. They react based on their length. So that's why a lot of people use like a 40 or a 50 or 100 or 200 period moving average, because, those are really a month and a half to roughly 2 months. 50 day moving average is roughly 2 trading months. 100 is 4 trading months. That's basically a quarter. And 200 is 8 trading months. That's basically 3/4 of a year. Okay, so you have a scenario where you must understand that indicators have potential faults. And I didn't do a great job of finding fault here, but and divergent, you can come up here and say, yeah, Brad, but look, this divergent range right here, it was gorgeous. Yep. Okay. This was a good example here. Okay. This was a decent example here where this setup here. And there may be 2 or 3 others here that qualified as divergent trending. But then I'm going to be able to pick very easily, areas like this where, oh, you have divergent trending. Oh, okay, it failed. Oh, you have divergent trending. Okay, it failed. Oh, you have divergent trending. Okay, it failed. Oh, you caught one lucky. Okay, good. And that's again what I want to try to tell you is that you must understand that price is the ultimate indicator. This is what drives the market. This is what feeds your gauges. This is what drives the trend in the indicators. Price is what does all that. Indicators are just a measurement of price. And once you understand the faults and the fact that these indicators are a measurement of price activity within a range of 14 bars or whatever it is, then you can start to really keep into perspective, which is why I tell everyone to really pay attention to weekly and daily data, and then go in and start making your determination about what you want to do. Here you can see we had a little bit of divergence right here. It's shot back up. A little bit of divergence right here, rolled around, shot up higher, eventually broke down right over here. Then we start getting these divergent trends here. Oh, it's diverging. Oh, it's diverging. And I'm not trying to pick on anybody, but I've been around these things long enough to know that there's some very good value in this. Like, for example, when RSI is moving higher and short-term stochastic is moving higher and longer-term stochastic is moving higher, you see here in this area, look, this right here, basically from this point on, up until here where we get to stochastics and RSI failing. We do get one little area right in here where we get a little failure. But this area here, this is how I use it or would be using it. And that is that I would be looking to be long in these areas. And then I would be looking for my GAN vibrational indicator to qualify for long triggers. So look at how clean this is. We come right over here, drag this out of the way, come back here, spread this out. Good, solid visual order, bring the front. We get anchor bar triggers right here. We get a good solid upward trend. So let me draw a vertical line right here. So that gives us our upward trend based on this long-term stochastic indicator. Prior to that, we were bearish. This is COVID. So right at this area, we get confirmation of faster stochastics, meaning short-term RSI is up, and longer-term stochastic is up, and my GAN vibration is positive. So at this point, I'm looking for longs, and I can take pretty much any anchor bar I want. Then as we move over into this area where short-term stochastics and RSI weakens, as well as my GAN vibrational system starts to weaken while we're in an uptrend here, this means that I want to try to cover my longs. I don't want to try to go short. If I take longs in this area, I want to be smaller allocation, really be cautious of a potential rollover here, a pullback. Then as we move back into regular long trading again, you can see here RSI moves higher right about here. Stochastics hooks up right about here. The longer term stochastic is still bullish, and my GAN vibrations went back to bullish. Now I'm looking again for longer term upward trending. I would get into a very solid confirmation trend right in this area, right off that low. Beautiful setup uptrend, 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 uptrend. And again, this is RSI with a moving average, a 2-period moving average, and we get a very solid uptrend. So what you can do with this, guys, is you can use these for the strengths that they show you. Remember, a 14-period moving average is only looking at 14 bars. So when I'm looking right here, it's telling me 14 bars ago, look at the range. Is the glass, where is the price, the glass full or empty compared to price? So if this is your glass, this is the total bottom and top of your glass. Where is price? It's at the top, so that means the glass is full. That means stochastic is going to represent a very high number, 100% really, or 99%, but we smooth it with 7 and 3. That gives us this number. And this is a measurement as price moves up, this indicator will move up. So as we move up here and move over here, now we get a new measurement. It's at 90. Now we move to here, measuring 9 low, measuring 9 low. Where's price? It's at 98. That's why stochastics continues to climb in this measure. It's measuring how full the range is, the glass is, based on the highest high, lowest low of 14 bars. Same thing with RSI, except it's measuring how many up bars, white bars we have, and what is the range of those bars totaled compared to the total range of the black bars. So when the up white bars outnumber the black bars, we get RSI moving higher. That's what relative strength is. It's again over a 14-period value, but when RSI continues to move higher like this, you're seeing essentially continued 14-bar strength to the upside until it peaks and rolls over. Now you're seeing that strength weaken over 14 bars and start to decline. What's happening here? You're getting more black bars, bigger black bars, and you're losing your predominance of white bars on RSI. Even though price didn't go down, you're getting, downward trending here because the black bars are becoming more predominant, more frequent than the white bars and outweighing the white bars. So you need to understand what the indicator, how it's made up, how it works to be able to really understand what you're getting and how to use them more efficiently. The purpose of this was to show you that all indicators essentially operate under the expectation that you're going to have a range and that you're going to be operating in a sine wave format. As soon as you get outside that traditional sine wave and things change, this area would be perfect for a 14-bar stochastics. This area is going to be okay. This area is going to be an extension beyond the range of the oscillator. So it's going to start giving you faults in this area and actually all of this. It'll start giving you faults because you've lost the sine wave. You're not in this perfect sine wave mode, which is what these oscillators are really designed to be capable of doing. They're designed for this type of price activity. They're not designed for this type of price activity, which is why you get the unusual activity, multiple faults, multiple divergences, and multiple issues that often confound and confuse many traders. Okay, this has been a little longer than I expected. I'm going to get back at it here. Okay, guys, let's go get some today. Hope this helps.